Thank you, organizers, for this event, for inviting me, and for this opportunity to speak in front of such audience. And I'd like to present some thoughts about modeling markets to understand the market risk model. For example, we will see some data from energy markets and financial markets, compare them, and try to forecast the risk associated with the current position of this market. The motivation for this page is as follows. From the point of view of valuation, we care about the price. We calculate expected asset price, and this is the start point for decision making. From risk management perspective, we have two more options, two more steps to be made. We can talk about risk modeling, which can provide us with information about the distribution of the possible asset value. And the second step, risk management, when we can structure our deal, structure our decision, so that to increase the probability of observing the expected value, or increase just expected value, etc. So to make the distribution more comfortable for us, for our assets, for our portfolio. From portfolio point of view, I'd like to talk about two steps at the very beginning, about the risk driver identification, about quest for invariant, and estimation of probability distribution for our asset price. These steps are very important from my perspective for the whole process of portfolio management, as all other steps will based on the data we obtain here, based on our projections, based on our reasons we discover data. The presentations contain three main steps. Pre-sequels, I try to present some thoughts about risk invariance and about how to separate the uncertainty from the data we have and from the raw data. The second step is the modeling effect of volatility clustering. I present some vanilla model from some starting model for filtering this risk invariant we need for our forecast, for our risk estimation. And the last step is some suggestions for improvements the model we can build at the second step. Let's go. And I'd like to begin with a simple question. We have two time series, first and second, and the question is, which series is easy to forecast? Which? Why? It's not such obvious that this is a mean regression, but essentially this two series is based on the same raw data. It's the time series for DAX, Deutsche Aktien Index, and this is the compounding return for the same index. The question, your suggestion that this time series is more easier to forecast is based on the simple assumption. We, even without any calculation, can say that we have some relatively stable expectation. We have mean, we can calculate mean, which is the stable from beginning of the 2014 up to this week, and these projections about the mean, at least about the mean, will be quite reasonable. But we can see the difference in variation from for this period of time, for this period of time, and this time series, the second time series, could be invariant, but in this case is just a proxy for this invariant. It's the starting point for risk estimation, for risk modeling. So we have a risk driver. If we have a position on equity market, the index, the changes, the index value is the first risk driver we can use for our modeling, and the second time series is proxy for our invariant. It's some manipulation with starting data. We have difference of log values of index level, and it can be used for our next modeling. I'm sorry. Depending on the market we are talking about, and depending on the instrument in question, we had to use different risk drivers, different risk invariant. For example, for equities, it will be compounding log value as a risk driver. It's a level of our equity price, a level of our index, market index, etc. As an invariant, the starting point will be the changes in risk driver. For example, for fixed income instruments, the risk driver is yield to maturity, and the risk invariant we have to model is the parameters for yield curve, etc. For credit risk, which influence the market price of our instrument, the risk driver will be default probability, and the invariant is leverage. Let's see some for example, we have some equity, some company with the following balance sheet in this corner, and we can, based on our risk invariance as leverage, simulate the changes in credit rating for this instrument, for this issuer. Based on this changes of our risk invariance, we have the changes in rating, dependent on the level of leverage associated with the credit rating we used for our modeling. As I already said, this proxy is not very useful for risk modeling without additional filtering. I mean that we have some deterministic component in this data, and we need only true stochastic component, true random component. Only based on this true stochastic component we can calculate our risk matrix, and it's this component could explain our expectation about risk. This component has no uncertainty. It's deterministic component. It's some function that define the part of our fluctuations. We need only part that is random, is uncertain from the point of view forecaster. This stochastic process, this stochastic component, has to be IAD process. First of all, it has to be identical and independently distributed over the time. If we have the IAD process generating this data, it has to be stable over time, and based on this, we can approximate the future expectation based on this data. If this data is not IED process, it is not stable, our forecast will not be reasonable, because some deterministic component can be move us from the right value for our risk estimation. And based on this, we have four cases with raw data. First of all, it's a random walk. It's a case when, after differentiating the levels, we have a truly IID process, and it's stable IID, and we can use this error term for our forecast, for our estimation for risk metrics. But in practice, we have three other cases when the process we obtain by differentiating the level of prices is not random walk, is not white noise, so the prices is not random walk. We have one case is a mean reverting process, when the prices moving around, and after up, they go down to some long-term level. Long memory, it's another effect. It more associated with high frequency data, with intraday trading, etc. And the third effect is volatility clustering. This effect I'm going to talk about in more details in next 10-15 minutes. And what does it mean? When we have one of these effects, when we do not have white noise, we have to use some filtering to obtain IED process for our forecasting, for our risk estimation. George Book said that essentially all models are wrong, but some are useful. So we have to find some useful model that can help us to obtain the IED process, the process that is stable in time, so our forecast will be reasonable. How we can obtain this? There are a lot of different models that different concepts that can be used to obtain IED process from raw data from volatility point of view. For example, it's GARCH, generalized autoregressive conditional stochasticity. Another model is stochastic volatility, local volatility, heteroscedastic, autoregressive, etc., etc. We are going to talk about GARCH. What we see in financial data, in energy data. Prices are generally not stationary, so we use differentiating to obtain the returns. Returns are usually stationary, more or less, but stationary. Some financial data is fractionally integrated. It's the case for of long memory effect. Returns usually shows no or little autocorrelation. But when we saw on when we look at squared return, we see the autocorrelation, positive, negative, but statistically significant autocorrelation. This is the case for volatility clustering, and we have to remove this autocorrelation in square returns. For example, let's see at its time series of oil prices. This is the return of oil prices for last almost 5 years, and this is the square return. We can see that here sorry. Here we have a low volatility. Here the same. But we have another period of high volatility. We can see this on time series of prices. We can see something in a series of returns, but it's more obvious when we look at volatility, when we look at squared returns. This is the same for S&P index. Most time we have low volatility, but we can observe some periods of relatively high volatility for this market. This is the natural gas price. The same, we have periods of low volatility, we have periods of high volatility, etc. When we based our risk estimation on average standard deviation for the whole period, the result will be misleading. It will be, we produce overpriced or underpriced risk metrics. We need to use conditional heteroscedasticity, conditional risk metrics. The conditional means that our risk matrix is based on the current situation. If we have high volatility, or we have high volatility, or we have low volatility. If we, in the situation of low volatility, our risk matrix will be 1, low. When we move to the time of high volatility, the risk metric should be higher to produce the reasonable indicator for decision making. This is the time series for hryvnia to dollar exchange rate. The same, we have almost no volatility, but have a period of extremely high volatility. How we can obtain the IED process based on GARCH model? We have a differentiating equation where we have an error term. It is not IED, but we can create an IED process, a stable process that has the same parameters for all time we need by using such construction. Error term is the Z, which is IED by construction. It's our decision, multiplied by square root of conditional variation. The variation is based on the current situation on the market. How we can produce this conditional variation? By using this equation. We have some value omega that define their long-term volatility level. We have two terms, lagged volatility, or lag variation, and the coefficient beta will explain the memory effect, how we remember the previous data, how we can recall their historical information, and omega t minus 1 is the last innovation in the market. It's the fluctuation on the market that observed in the previous period. And the coefficient alpha 1 will be the coefficient that explain our sensitivity to new information. When we have new information, some fluctuation of the market, multiplied by this coefficient, we update our view on the conditional variation. And the sigma, which we use for, which can be used to calculate, for example, value at risk, is produced as a square root of conditional variation. Just simple combination. Another method, another concept to produce, to make almost the same thing is the model of stochastic volatility. The only difference is that we make the decision that there are two IED processes that generate our data. Error term is generated by the same equation, but in equation that update our views on conditional variation, we have no lagged value, but we no innovation value based on the current market situation, but we have some random component, random changes in variation on the market. Also, we can put some limitation on the correlation between these two processes. Later, we are going to talk about this model, these components. The evolution of GARCH, this concept quite old. Everything began in 1982 with the paper published by Eagle, autoregressive conditional heteroscedasticity with estimates of variance of United Kingdom inflation. In 20 years, in 2003, Eagle received the Nobel Prize for this paper and some other paper on the GARCH model. In 86, Tim Boleslav published generalized autoregressive conditional heteroscedasticity. It's exactly these three equations. Was published in 1986. 1 year later, Eagle, Leland, and Reddins published the paper on GARCH in mean. It's the model when we that help us to separate the risk premium in our equation. And in 1993, Dick, Grunch, and Eagle published a new paper on asymmetric power GARCH, etc., etc. In last several paper published by Boleslav, he found more than 500 different specifications for GARCH models. 500 different specifications for these three equations. We are going to talk about some of them. And we begin with so-called vanilla GARCH model, the standard GARCH model, which has two components, deterministic components, as we defined earlier. It's some function, G, that explain our expectation about returns. And conditional stochastic component, conditional volatility, it's some equation that explain our views on market fluctuations, on market volatility. Combining these two components, we receive our risk driver, and we can make a reasonable decision based on this information. Okay, the first model I'd like to present is GARCH 1.1. 1 means that we take into account only one leg for for historical volatility and one leg for innovation we observed on the market. First model assume that that error term, that IAD process is normally distributed with 0 mean and 1 as variance. And later we will see the calibrated model for TTF day ahead natural gas price daily data, and the same as a proxy for energy markets, and Deutsche Aktienindex daily data as a proxy for financial markets, and we can see the difference between these two markets. The result is as follows. This is a specification for our model, standard GARCH model with 1 legs, and this is the coefficient omega almost 0, alpha 1 0.2, and beta 1 is 0.76. This means that for natural gas TTF day-ahead price, the sensitivity for new information is 20%. Any fluctuation that we observe on the market is transferred in increase of our views on future volatility with coefficient of 21%. 76% of our expected volatility is based on the historical information. From the volatility we was expecting in a previous period. It's quite similar for energy markets, and this is the same model calibrated based on daily data of German index. We have alpha only 7%. Only 7% is sensitivity of the model to the new information, and 91% of our expectation is based on the previous expectation. Quite persistent expectation of our market volatility. We can calculate unconditional volatility, long-term value, which to which the market is going in a long-term perspective. It's calculated as 1 divided, not 1, I'm sorry, omega divided by 1 minus alpha minus beta. It's 1.18% for DAX index and 3.22% for natural gas prices. Okay, let's see how the model perform. And first test we need to do is to see how we filtered out the volatility clustering. This is the autocorrelation function for gas and for stock market, German stock market, based on raw data. We can see that autocorrelation is quite significant. 35% for one leg in case of natural gas, and almost 20% only on one leg for German stock market. And this is the same function, autocorrelation function, based on squared return after using GARCH model. You can see that in this case, in case of financial market, we remove all volatility clustering. All functions for all legs is statistically insignificant. We have some problems with natural gas prices, as we have statistically significant function values for 2, 4, and 5 legs. It says that the model is not very, very good, but could be useful. This is the backtesting for risk metrics, value at risk limits. How we can calculate value at risk. As you remember, value at risk based on parametric method is calculated as a coefficient that defined by the confidence interval multiplied by sigma. We have epsilon as an IED process. We can calculate the coefficient for this process. In case of our specification, in case of normal law, it will be 2.32 as a coefficient for 99% value at risk, and this coefficient has to be multiplied by actual updated conditional variation. This is exactly we can see on this plot. This is for this is for natural gas and stock market. We can see that in most cases the model produces a good risk metric, but we saw some deviation some errors with limits. In case of financial markets, we have a lot of errors. In case of negative changes in price, in case of negative returns. And for natural gas, we have the opposite problem. We have a lot of problems with positive changes, positive returns that extremely high, that break our risk limit. Why we have such problems? This is because our model produces a symmetric linear news impact curve. Any new information, any fluctuation on risk convert to the updated volatility based on the symmetric sensitivity. Plus 0.5% produce the same effect on the future volatility as returns with minus 0.5. It's not true for empirical data, so we have to remove the problem with breaks of our limit in mostly in one direction. We have to reformulate our model to change this news impact curve. Another test is forecast for next 64 days. This is forecast for expected mean, for drift in prices. Based on our specification, it's not surprised that we have a zero value. Yellow band is the confidence interval for our expected mean, and the second plot is for unconditional sigma, our forecast for volatility. In the case of natural gas, we have unreasonable low volatility today, so the model expects that this volatility will grow up to the long-term mean. For the case of German stock market, we have the volatility almost on the long-term value, so the model produces almost no changes to the current expected volatility. This is the mechanics, this is the results for our simple vanilla GARCH model. And the last but not least test for our model is the comparison, is the check whether our IED process that we generated by our model is exactly the same as we expected. We make the assumption that the IED process should be normally distributed with zero mean and one as variance. This is theoretical quantiles for our assumption, and this is the sample quantiles based on our outcomes. In ideal situation, all blue dots has to be on this line. In our case, we have a huge deviation on the tails of our distributions that tell us that our assumption about normality is not valid. We have a very huge deviation even at 2 sigma. It's something like 90% confidence interval. And for value at risk at 99%, we have a huge underestimated risk metric based on this assumption. This tells us that we have to modify our model in case to use it with our data. Which we have 3 basic problems with our data. In our case, it's an appropriate distribution for that. We assume that it's normal, but it is not normal. We have to use a different distribution, or at least we can use a normal distribution with additional information about certain forth moments. Include stochastic, or include kurtosis and skewness in our calculations. The second problem is the asymmetry in the expected volatility reaction to the market innovation. We have to include some leverage effect in our model to remove this problem. And the last one is nonlinearity in reaction. We have so-called Taylor effect. We have to remove this effect to produce the ideal model that will be most useful in our case. Let's do all these three things. First problem is assumption, normality assumption. Here is the result, the same model, same GARCH 1.1 model, but with the assumption that the IED process is follow the student T distribution for natural gas prices, and skewed student T distribution for financial markets. It's new coefficients, and we can see that we have positively skewed distribution for financial markets. It's we have the theoretical rationale for this, and the student distribution has 6 degrees of freedoms. For the natural gas prices, we use just student T without additional skewness, and we have the lower sensitivity to new information. Instead of 21%, we have 19%, and we have a shape parameters that define the shape of student T distribution, 6.9. Okay, it's the starting parameters. We can compare this data and saw the difference we obtain. Here is the test for validity of our assumption about student T distribution and skewed student T distribution. In case of natural gas prices, we have quite good result. We have little deviation on the extreme tails, but for financial markets we have the problem. We have a sigma S-like QQ plot. It's tell us that the problem is not only with our assumption about skewed student T distributions. It tells us that there is another problems: nonlinearity, asymmetry, etc. How we can resolve these problems? The next problem we have is asymmetry. To remove this problem, we can use exponential GARCH model with the same assumption about distribution that describe the ZT. This is the general formula for this model. It's the same components omega as the components that define long-term volatility. It's some exogenous factors that can be used to explain the changes in volatility. It's the memory effect that explain how we remember the previous data about volatility level. And here is our sensitivity to innovation. We have a sensitivity to market fluctuation, but we include also the sensitivity only to positive fluctuation of the market. We include fluctuation twice. One, we include all fluctuations, negative and positive returns, and plus with some sensitivity coefficient, we include only positive returns and ignore all negative returns. And we see that after calibrating the model, we obtain gamma coefficient 30%. That means that natural gas prices is extremely sensitive to positive returns in previous period. It means that when the price goes up, our risk expectation goes up too. In the case of financial markets, we have the opposite. In most cases, we have the opposite opposite situation. It means that we could expect that the gamma coefficient should be negative, but in our case it's positive, with some problems with negative coefficient in omega and alpha. It means that this specification is not very useful for financial markets. It produces counterintuitive results. When equity price go up, we can expect that our risk expectations should go down. Equity price is high in the case when companies do well. When companies do well, our risk estimates should be low. But when the companies do bad, the equity price go down, and our expectation for risk should be higher because of some economical problems, because of maybe recession in economy, etc., etc. The model produces some counterintuitive results in this case. This is news impact curve. It shows that natural gas price is extremely sensitive to positive returns. When the price go up, we expect a huge increase in risk metrics, and we should use some additional buffers to cover this information, to cover this possible problems with returns, with our profit and losses. In case of stock market, we have the opposite curve. Almost no sensitivity to positive information and parabolic form for the segment that explains our sensitivity to negative information on the market. This is backtesting for risk metrics. We see that breaks for our limits are quite normally distributed. Another alternative to remove asymmetry problem is using GARCH model. It's quite simpler. We have our sensitivity to returns, squared returns, plus our sensitivity to negative returns. I, its identity function, which has value 1 for negative returns and value 0 for positive returns. And this is the coefficients for our model based on our empirical data. We have a negative reaction to negative information. This is the case for all commodities. And we have gamma 1 positive information for positive reaction for negative information for financial markets. The case, a typical case for most financial instruments. And this is the profile of such sensitivity in this model. And last one is the GARCH, threshold GARCH model, with the same assumption about distribution of ZIID process. It produces nonlinear in terms of squared return reaction function to new information, and we saw quite similar reaction profile for different markets. Financial markets is sensitive for negative information. Negative information produce higher risk, and the commodity markets sensitive to positive returns. Price increase produce higher risk metrics. It's some stylized facts for volatility analysis. And this is the backtesting for valued risk limits based on our last model, and this is all I'd like I plan to talk today. Maybe any questions?
Thank you. So again, I'm the first to go. I definitely cannot compare with you in knowing this GARCH model, so I'll try to ask a practical question about the clustering volatility. The biggest debate that equity analysts usually have between themselves and managers and clients is when you do the valuation of the equity, for example, you normally use the constant discount rate for the all forecast period. Some analysts use varying discount rate, but that looks suspicious usually. You can hardly prove why you are, for example, increasing or decreasing your risk-free rate over a forecasted period. But it's now looking at this, I think it's naive to assume that the discount rate or risk-free rate in your model can be stable for next 10, 15 years. And most likely it will be subject to these periods of high volatility periodically. And so my question is, and of course, if you use 10, 15 years forecast period, and in some periods you would use different, for example, risk rate or cost of equity, and in these periods you are valuing the cyclical company with a cyclical business, that would affect your model for sure. So what's, in your opinion, is it justified to use varying risk-free rate or discount rate based on this model? And can you forecast actually these periods when, or somehow model these periods of elevated volatility?
In case of talking about discount rate and talking about interest rates in general, in most cases we have the problem. We have another problem. Its problem is not volatility clustering. It's mean reverting. Interest rates shows that they have some equilibrium level of interest rate, whether it risk-free rate or market rate for some periods, yield to maturity, etc. But the modern models of mean reverting interest rates also incorporate the volatility component. Even there are a lot of extension to Vasicek model that explain the short-term interest rate movements that incorporate the volatility clustering to explain how the stochastic component that generate the changes in interest rate can be modeled, can be forecast based on some volatility clustering effect. It's quite popular in last 5-10 years.
Okay, thank you very much for this description of GARCH models. If I understand you correctly, the GARCH models would provide much better estimates for the expected return and standard deviation if we compare just with like a historical sample mean and historical sample standard deviation. Is it correct? So basically, conditional expected value is more accurate than unconditional, and
yeah, of course, unconditional assumption is valid in the case when we have IED process, the process which is stable over time, but it's not valid in the case of unstable process. But conditional volatility GARCH model is primarily talk about conditional volatility. Conditional mean our conditional expectation about drift in price, drift in interest rate has to be modeled, could be modeled with any other assumption. In all models I was presenting earlier, I made an assumption that conditional, my expectation about mean is 0. I expect 0 drift. It's quite common assumption for financial market, for energy markets. It means that I expect no changes in price. The future price should be the same if we have no additional information. In this case, the GARCH model actually produce the forecast for returns. But when we build a more complex model and use G function, it could be ARMA model, it could be Arimax model, it's any model. The risk driver, the expectation about risk changes will be driven not only by GARCH model, but also the G function we incorporate in our model.
Okay, and could we continue from this slide? So, for example, if I need not only one asset, if I need several decision variables, for example, if I'm an asset manager, I'm interested in asset weights for different assets in a portfolio. So that's useful for like estimating the expected return and variance. But what to do with correlation metrics? Is it possible to use?
I understand. Okay, thank you for the question. This model can be generalized on multivariate world when we have 2, 3, or more assets. In this case, the notation will be the same, but all these variables will be not a number, it will be a matrix. The matrix that incorporate the correlation effect between assets in our portfolio. If we calibrate our multivariate GARCH model, we will see not just alpha 1 coefficient, it will be a matrix 3 by 3 for the portfolio with 3 assets, this matrix will explain our sensitivity to changes on all 3 markets. If we, for example, combine these 2 assets in one portfolio containing 2 assets, we will have alpha as a matrix 2 by 2, and we will have the alpha 1, 1 that explain the sensitivity of gas matrix to gas changes. Alpha 1, 2 will explain our sensitivity from the point of view of energy market to changes on share market, etc. So it's not a problem to generalize this concept to portfolio, and this is used in practice for portfolio optimization also. But in this case, we will see the computation problem. For GARCH 1, we have three parameters in this case, but when we will analyze the portfolio of 3 assets, we will have 1, 3 in power to 9, plus 9, we will have at least 11 parameters. In case for 4 assets, we will have 33 parameters, etc. It's the problem with computational problem, and the problem with how to find the optimum that show us all coefficients we need. It's the only this problem. This is not problem with the concept, it's problem to have an efficient algorithm to solve these equations.